Most people believe you need a lot of money to start investing, but I learned something very different over time. Today I want to show you how just $25 a week can slowly transform your financial future. Before we begin, understand this video is not about shortcuts, hype, or risky speculation in the stock market. This is about patience, consistency, and letting simple strategies quietly work for you behind the scenes. If building passive income and long-term financial freedom matters to you, this channel was created exactly for that purpose. I share clear, practical investing ideas here, so consider liking this video to support more content like this. If you are serious about improving your financial life, subscribing helps you stay consistent and focused long-term. Also, feel free to comment the number 25 if you are starting small and want accountability from this community. I started my journey without large savings, advanced knowledge, or insider connections, just discipline and a simple plan. Many people wait for the perfect moment to invest, but waiting usually costs more than starting imperfectly. I realized early that consistency matters more than timing when you are building wealth from a small base. Instead of stressing about market news, I focused on building habits that could work in any environment. The strategy I use today helped me stop overthinking and start letting my money quietly work every week. It is designed for normal people with jobs, bills, and limited time, not professional traders or financial experts. You do not need to predict crashes, recessions, or rallies for this approach to work over decades. What you need instead is a clear system that removes emotion and replaces it with automatic discipline. That system is built around dividends, reinvestment, and adding small amounts of money consistently. When you combine time with reinvested dividends, something powerful begins happening beneath the surface. At first, the progress feels slow, almost invisible, which is why most people quit too early. But if you stay patient, those small weekly contributions start creating momentum that surprises most investors. One of the biggest mental barriers I faced was believing my money was simply too small to create real change. When you only invest $25 a week, it feels insignificant compared to stories of overnight financial success. But real wealth is rarely built through dramatic actions. It grows from boring habits repeated patiently over time. Most people fail financially not because they lack intelligence, but because they quit before consistency can compound. I once believed investing was reserved only for people with high incomes and advanced financial knowledge. That belief kept me stuck watching others progress while I waited for a perfect moment that never came. Markets do not reward perfection, they reward participation combined with patience and long-term commitment. Instead of asking how fast I could get rich, I began asking how long I could stay invested. That single mindset shift completely changed how I viewed money, risk, discipline, and long-term planning. I stopped chasing fast wins and focused on building systems that worked without constant emotional decisions. This shift naturally led me toward dividend investing as the foundation of my entire financial strategy. Dividends felt different because they paid me real cash, not just fluctuating numbers on a screen. Even small dividend payments motivated me because they proved my money was actively working for me. Instead of spending those dividends, I committed to reinvesting them automatically using a simple structured plan. This approach is known as DRIP, which stands for Dividend Reinvestment Plan in investing terms. DRIP allowed me to convert every dividend payment into additional ownership without any extra effort. Each new share purchased through reinvestment immediately began producing dividends of its own. Over time, this created a powerful loop where money consistently generated more money automatically. The beauty of this system is that it works quietly while I focus on my everyday responsibilities. In the beginning, progress feels slow, but DRIP reveals its true strength after years of disciplined consistency. The real engine behind this strategy is compound interest, something most investors severely underestimate during the early years. Compounding works quietly at first, producing results so small that many investors wrongly assume nothing important is happening. I think of compound interest like planting a seed that grows underground long before it ever breaks the surface. During the early years, you keep watering the soil consistently even though you cannot see visible progress yet. Most people quit investing during this phase because patience feels harder than taking quick action today for many beginners. Compounding rewards those who stay consistent while everyone else loses interest, focus, and long-term discipline over time. To keep this simple, imagine owning 100 shares of a reliable dividend-paying company as a simple example today. Each share pays $1 annually, giving you $100 in dividends at the end of each year. Instead of spending that money, you reinvest it to purchase additional shares automatically through your broker every year. Now you own more shares, which means next year your dividend payment becomes slightly larger than before again. That extra income then buys even more shares, increasing your ownership without adding new personal money into the system. Year after year, this cycle repeats, slowly accelerating as your total share count continues growing over time consistently. At first, the increases feel small, but compounding works exponentially rather than growing in a straight line long term. The biggest growth happens later, which is why starting early matters far more than starting with big money. Most charts fail to show this clearly, causing many people to underestimate long-term investing benefits dramatically over decades. When time and reinvestment combine, your portfolio begins growing faster with each passing year, almost without extra effort. Eventually, dividends contribute more to growth than your original weekly contributions ever did at the beginning of your journey. This is when investing stops feeling like constant effort and starts feeling like unstoppable momentum over long periods. Compounding rewards, discipline, and patience, not intelligence, luck, or perfect predictions about markets made by investors over decades. Once I truly understood this principle, staying consistent with small weekly investments became much easier for me personally. Another key part of my strategy is dollar cost averaging, which helped me stop fearing market volatility cycles. Dollar cost averaging means I invest the same amount regularly, regardless of whether prices rise or fall short term. This approach removed the pressure of trying to predict market tops, bottoms, crashes, or sudden rallies every single week. When prices are high, my fixed investment buys fewer shares, but when prices fall, it buys more automatically over time. Over time, this balances out my average purchase price and reduces emotional stress during market swings and uncertainty periods. Instead of panicking during downturns, I see lower prices as opportunities to buy more ownership consistently over time. This mindset shift helped me stay calm while others reacted emotionally to daily market headlines and short-term noise. By investing weekly, I removed decision-making from the process and replaced it with simple automation through my broker. This consistency allowed me to invest through bull markets, bear markets, and uncertain economic periods without constant worry. I no longer worried about perfect timing because my strategy worked regardless of short-term price movements or headlines. Dollar cost averaging also protected me from investing too much money at the worst possible moments during emotional spikes. Instead, my investments were spread evenly across time, reducing risk caused by market unpredictability and emotional decision-making mistakes. This approach made investing feel boring, which is actually a positive sign for long-term success and sustainability. Boring strategies often outperform exciting ones because they keep people invested during difficult periods without emotional burnout risk. I learned that avoiding mistakes is often more important than chasing extraordinary returns quickly in volatile market cycles. Dollar cost averaging supported my discipline by giving me a clear rule to follow every single week automatically. Once that habit was established, investing became routine rather than something stressful or overwhelming for my lifestyle long term. This allowed me to focus my energy on earning more income and enjoying life outside the markets consistently. When investing stops controlling your emotions, it becomes much easier to stay committed long term through ups and downs. That emotional stability is critical when your goal is building passive income over decades with limited starting capital. You might wonder why I chose $25 weekly instead of larger irregular contributions each month consistently. The reason is simple. Weekly investing builds stronger habits and accelerates compounding without overwhelming my budget long term. $25 feels manageable, making it easier to stay disciplined even during stressful financial weeks for everyone. Weekly contributions also increase how often my money enters the market, improving dollar cost averaging effectiveness over time. More frequent investing means more opportunities to buy shares at different prices throughout the year market cycles consistently. This frequency matters because markets move constantly, and spreading purchases smooths volatility naturally over long periods for investors everywhere. By pairing weekly contributions with dividend reinvestment, I effectively supercharge the traditional drip strategy for long-term growth. Every week adds new capital, while dividends simultaneously buy more shares without additional effort from me personally each time. This combination accelerates compounding because contributions and dividends work together rather than separately over many years for investors. I did not increase risk. I simply increased consistency and time in the market through steady weekly investing. This approach fits real life, especially for people balancing jobs, families, and financial responsibilities without added stress daily. You do not need perfect conditions, you need a system that works during imperfect circumstances consistently over decades. Weekly investing removes excuses because the amount is small enough to repeat endlessly without disrupting normal spending habits. Once automated, this strategy runs quietly in the background without constant attention or emotional decision-making stress ever. Automation protected me from skipping weeks, overthinking decisions, or reacting emotionally to headlines during volatile market news cycles. Consistency, not motivation, became the driving force behind my investing progress over long periods, even when enthusiasm faded. This is how small numbers quietly gain power when repeated long enough across many years, compounding steadily forward. Most people underestimate consistency because results are delayed, not because strategies failed during early investment years, typically speaking. I learned to respect time as my greatest ally when building wealth slowly through disciplined weekly investing habits. With this foundation in place, the next step is choosing the right dividend stocks to support long-term growth. Choosing the right dividend stocks matters because consistency depends on stable businesses that can pay and grow dividends. I do not look for hype companies, I look for businesses with proven cash flow and shareholder-friendly histories. To simplify decisions, I group dividend stocks into 4 categories that work together consistently over long periods for investors. The first category is blue chip dividend stocks, known for stability, scale, and reliable dividend payments over decades. These companies usually survive recessions, adapt to change, and continue rewarding shareholders through different economic cycles worldwide markets. They form the foundation of my portfolio because reliability matters when building income meant to last decades consistently. The second category includes dividend aristocrats, companies that have increased dividends for at least 25 consecutive years. This long track record signals strong management discipline and commitment to shareholders even during challenging markets' economic cycles. Aristocrats help stabilize returns because dividend growth often continues, even when stock prices fluctuate, short-term volatility persists. The third category focuses on higher yield dividend stocks that provide stronger income earlier in the journey initially. These stocks boost cash flow but require careful selection to avoid unsustainable payouts and unnecessary risk over time. I balance them with stability stocks so income grows without putting the entire portfolio under pressure long term. The fourth category is growth-oriented dividend stocks, combining rising dividends with long-term business expansion potential ahead. These companies may yield less today, but often deliver faster dividend growth and capital appreciation later for investors. Technology and innovative businesses frequently appear here, but only if cash flows support sustainable dividends over long periods. I do not chase all 4 categories equally. I focus on balance and long-term reliability for income. My rule is simple. Every stock should meet at least 3 of these 4 criteria consistently over time. This filter removes weak businesses and keeps my portfolio focused on quality rather than speculation and hype cycles. By narrowing choices, I reduce mistakes and increase the odds of dependable dividend growth over many market cycles. With stock categories clear, I can now build a portfolio designed to compound steadily for decades ahead calmly. After defining my stock categories, I built a simple, diversified portfolio designed for long-term dividend growth. I intentionally avoided complexity because simple portfolios are easier to maintain consistently over decades without emotional mistakes. Each stock in my portfolio serves a specific role, either stability, income, growth, or a balanced combination. Together, these roles work like a team, supporting steady cash flow and long-term appreciation simultaneously. Instead of guessing outcomes, I focus on measurable metrics like dividend yields, dividend growth, and business durability. Dividend yield shows how much income a stock pays today relative to its price, expressed as a percentage. Dividend growth indicates how fast that income has increased historically, helping predict future income potential. Price appreciation reflects how the underlying business value has grown over time, increasing portfolio worth. When these three metrics work together, the portfolio can grow income and value simultaneously. I average these metrics across my holdings to understand overall portfolio performance rather than individual stock noise. This approach smooths out extremes and keeps expectations realistic for long-term planning purposes. The goal is not maximizing returns every year, but achieving dependable growth over many market cycles. By reinvesting dividends, income compounds while underlying businesses continue expanding gradually. Over time, the portfolio begins generating meaningful cash flow without requiring additional decision-making. This simplicity allows me to stay invested during uncertainty instead of reacting emotionally to short-term fluctuations. Clear structure also makes it easier to adjust contributions without changing the strategy itself. As contributions continue weekly, portfolio momentum increases even if individual stocks temporarily underperform. I remind myself that diversification is protection against being wrong, not a guarantee of perfect outcomes. With discipline and time, average results can still produce extraordinary long-term financial outcomes. Next, I want to show how this portfolio evolves numerically over 30 years with weekly contributions. To understand long-term impact, I modeled what happens when $25 is invested weekly for decades. At first year, one looks unimpressive because contributions are small and compounding has barely started working yet today. During the first few years, growth feels slow, testing patience and tempting many people to stop investing early. Around 10 years in, momentum begins building as dividends and contributions start reinforcing each other steadily over time. The portfolio balance becomes meaningful, and dividend payments finally feel noticeable rather than symbolic milestones along the way. Even by year 20, compounding accelerates significantly, and annual dividend income starts covering real monthly expenses for everyday living. This stage surprises most people because dividends contribute more growth than new money added each year consistently now. Emotionally, confidence increases because results are visible, making it easier to stay invested during uncertainty and market stress. At 30 years, the portfolio reaches a level that once seemed completely unrealistic when starting small decades ago. Total contributions appear tiny compared to portfolio value, proving time and discipline outperform intensity over long investment horizons. This growth did not require luck, perfect timing, or advanced skills, only consistency maintained year after year patiently. The numbers tell a clear story. Small weekly actions become powerful when repeated across decades with discipline, focus. Seeing this projection helped me trust the process and ignore short-term noise completely in financial markets daily. It also reminded me that patience is not passive, it is an active decision repeated consistently over time. Once this perspective clicks, sticking with weekly investing becomes far easier emotionally for most people long-term success. The timeline matters more than the starting amount, which is why beginning today is critical for future freedom. Delaying another year costs more potential growth than increasing contributions slightly later because compounding loses valuable early time. This realization shifted my urgency from chasing returns to protecting time as my most valuable financial asset long term. With the timeline clear, the final question becomes whether this income can support retirement comfortably and reliably long term. That is exactly what I want to explore next, using realistic dividend income estimates based on history data. Now let us talk about income, because portfolio value alone does not pay monthly bills or living expenses. The real goal is reliable cash flow that arrives consistently without selling assets or relying on market timing. Dividend income provides that stability because it is paid regularly from business profits, not stock price movements. To estimate income realistically, I focus on conservative dividend yields rather than optimistic projections or best-case scenarios. Historically, diversified dividend portfolios often produce yields between 2 and 4% over long periods. Using conservative assumptions protects against disappointment and builds confidence that income remains sustainable during downturns. For example, a $500,000 portfolio yielding 4% generates $20,000 annually. That equals roughly $1,600 per month, which already covers meaningful expenses for many households. As the portfolio continues growing, both dividend payments and reinvestment potential increase together over time. Reaching $5,000 monthly requires a larger portfolio, but decades of compounding make this achievable. Importantly, dividend growth increases income faster than inflation, preserving purchasing power throughout retirement years. This reduces reliance on selling assets, which can be risky during market downturns or recessions. I prefer income strategies that let me sleep well, knowing cash flow continues regardless of market sentiment. Consistent dividends provide psychological comfort that stock price volatility alone cannot offer investors. Over time, dividend income becomes predictable, turning investing into a reliable income system rather than speculation. This predictability allows better planning for housing, healthcare, and lifestyle choices later in life. It also reduces emotional stress because income arrives even when markets temporarily move sideways or decline. When income replaces paychecks, financial freedom feels real, not theoretical or dependent on market optimism. That is why dividend investing aligns perfectly with long-term retirement planning using disciplined weekly contributions. Finally, let us bring everything together and decide whether this strategy fits your personal financial situation. At this point, the strategy should feel realistic, not magical, because everything relies on time discipline and consistency alone today. There is nothing secret here, only principles most people ignore, because results take years, not weeks, to appear clearly visible. I did not build this plan to impress anyone. I built it to work quietly while life continued normally daily. Small weekly investments removed pressure and allowed progress without sacrificing lifestyle or financial stability for most people over long periods. This approach rewards patience, not perfection, and favors people willing to stay consistent through boring periods for many long years. If you are waiting for confidence before starting, understand confidence grows after action, not before, through repetition, experience, and practice. The best time to begin was years ago, but the second best time is today for most people watching now. Starting with $25 weekly is not a weakness. It is realistic and sustainable for long-term investing goals. Over time, discipline compounds just like money-creating habits that support long-term financial success for ordinary people everywhere today. You do not need to copy my numbers. You need to commit to a process that fits your life comfortably. If this video helped you see investing more clearly, support the channel by liking and sharing it with others today. Comment below where you are starting from, because writing it down increases accountability and commitment for your personal financial journey. I read many comments personally, and they help shape future videos for this community with better clarity, focus, and value. Subscribe if you want more practical investing strategies explained simply without unnecessary complexity or hype from this educational finance channel. This channel exists to help normal people build wealth patiently in a noisy financial world filled with misinformation daily online. Remember, consistency beats intensity when building passive income over decades through steady habits, discipline, and patient long-term commitment always. Small actions repeated long enough always outperform big actions taken briefly by most people over their investing lifetimes consistently overall. If you stay committed, time will do most of the heavy lifting financially for your future goals and freedom journey. Thank you for spending your time here, because time is your most valuable asset when investing patiently over many years. I will see you in the next video, where we continue building financial independence together, step by step, consistently forward.